Hello everyone and welcome back. I hope you're not getting tired of me as of yet. Today is actually the first day of the New Zealand lockdown, and so hopefully by the time you are watching this video, we will be in a better situation. Anyway, today's topic is still financial statements, but we will be focusing on the cash flow statement. As I mentioned in the previous classes, I think that this is probably the most important for a startup because cash is king. Cash is very important for young companies. They usually don't have much of it. They need to preserve it, they need to invest it properly and monitor how their cash will change across quarters and years. So we will be looking at the official financial statements. We will give an example of Coca Cola, but remember that you can also have something called management accounting. And so you can twist the cash flow statement to your needs. So you don't need to follow what the government or what listed companies do. You can use the same structure to guide your structure, but again, you can change it depending on your business and how you see fit. I've uploaded online an example of a startup in the video game industry. It's called Aizen. And in that case, you can see that we have forecasted cash flow using number of users, type of users that will be paying, type of users that are just there for free, put in some advertising revenues, and then we put all the different employees. So we just use what we think is intuitively sensible for the business at the time we made that cash flow statement. So again, today's topic is cash flow statement. We will be looking at the official format, but for your needs, you can target it and change it just to give you a better information in one place. So what's inside a cash flow? So cash flow is a document that shows you where your cash comes from and where it goes. So everything, every type of cash inflow and cash outflow. So just think what comes out and inside your bank account. Any type of cost that is cash-based will just go into your cash flow. You can divide your cash flow in three types of activities. The first one is operating, which means any cash that comes and goes for your trading. For example, if you're selling products, everything related to buying raw materials, selling your products, paying your employees, whatever related to your business in the strict term. The second one is financing activities. So you're not selling products, but for example, you can have more cash coming into your account because you have got a loan from the bank. So the bank gives you $100,000, which means that your bank account grows by $100,000. The same when you're paying back your debt, or when you're paying dividends, or you're buying back your shares. So whatever related to financing will change the level of your cash in your bank, but is not related to your main operations, again, selling products. And lastly, investing activities. In this case is buying non-trading assets. So for example, if you are buying a car or buying your warehouse, these will go into your investing activities. And although those are relevant for your business, they're not strictly related to trading. So these are the three main activities, the three main sections of a cash flow statement. The sum of these three will give you the net change in cash for the entire business. So let's look at the Coca-Cola example again. So this is a cash flow for 12 months from 1st of January 2016 to the 31st of January 2016. In this case, you can see that the official statement starts from the net income. So these are the profits that the company has generated. These are the same that you would have found in the income statement. To this number, they are adding and deducting certain items that are not cash related. So you might remember that I explained you the difference between income statement and cash flow statement in relation to depreciation. So depreciation is, for example, when you buy a car, your car will cost $10,000, then every year will lose 10% of its value. So second year will be worth 9,000, third year will be worth 8,000, and so on. This 1,000 difference is a decline in real value, but it's not a decline in your cash, because once you spend $10,000, nothing changes in your cash flow, right? You have minus $10,000 in first year, then nothing else until you sell the car. And so basically what Coca-Cola is doing is adding back those $1,000 a year that they are not actually spending as a cash outflow. It's just I don't know, it's a way to account for the cost, but it's not a cash outflow, okay? Remember, those $1,000 are not coming out of the Coca-Cola's bank account. So they're adding that to the cash outflow. So overall, here you can see that Coca-Cola has generated $8.8 billion between their profits and the other items that they have occurred in your income statement. I would advise you not to follow this structure because it's a little bit more complex. So my advice is just think about every operational item that will have a cash impact on your cash flow. So for example, every revenue, every salary, every raw material you're spending. So whatever item you have that will impact your cash flow, just put it here. And this will give you the sum of the inflow and outflow, will give you the net operating cash flow. So everything related to your trading. Then you can see here that they had almost $1 billion negative cash from investing activities. So in this case, they have spent $2.2 billion in capital expenditures. So for example, they might have bought other companies, they might have acquired other companies, they might have built a warehouse or a factory to produce drinks. So then they will have spent $2.2 billion in terms of investing activities. Here, there's other investing cash flow items. I don't know exactly what that is, but maybe they have sold, for example, factories. And so the net difference is a $1 billion net cash outflow. And finally, the third item is the cash from financing activities. So here, for example, you can see that they paid $6 billion in dividends. So $6 billion has gone out from their account into their shareholders' account. They have also purchased, so they have retired, you see, retirements of stock for $2.2 billion. So this means that they've given $2.2 billion to their shareholders, and the shareholders have given them their shares. So the shares of Coca-Cola as a company, the number of shares has declined. The reason why listed companies buy back shares is because by reducing the number of shares, you are increasing the proportion that every shareholder remaining has in the company. So this means, for example, that the earnings per share will increase. Imagine if you have $100 in profits and 100 shareholders, this means that $1 profit for one share. But if you keep the profit constant and the shares decrease by half, the profit per share goes up by 2. So this is some sort of financial engineering that listed companies do to increase their earnings per share, even if their earnings in total are not changing. And finally, they are doing these operations by financing them also with $1.6 billion of debt. So they're asking the banks to provide $1.6 billion in debt. And again, the reason is that now debt is cheap, and so they prefer to reduce the number of equity owners and increase the debt. So their capital structure is being adjusted to increase their probably return on equity, earning per share, and so on. So in total, you can see that cash from financing activity is significantly negative, $6.5 billion. So in total, the net change in cash for Coca-Cola is positive $1.2 billion. So basically they have almost 9, and here you go, minus 1 is 8, minus 6.5 is approximately 1.5 billion left. Okay, so this is the structure of Coca-Cola. If you're looking at young, tech, innovative companies, it will probably be very different. Usually companies are increasing a lot from financing activities, so they get a lot of equity inflow, so they sell shares, maybe let's say $1 million they need every year to sustain and grow their business, and they spend these $1 million in investing activities. Maybe they buy new computers and I don't know, a new warehouse, and also their operating activities are probably negative because they're investing a lot in growing the business. And so you might be looking at a different cash structure. Coca-Cola is a mature business. If you have a young tech companies, probably the structure could be similar, but the distribution of the cash inflow and outflow might be different depending on the business. So again, this is a cash flow statement official of Coca-Cola. You can try to follow the similar structure, but feel free to adjust it so that it's easier, simpler, and more targeted to your business. If you want to take an example, look online to the as an example. So remember that profits, as we mentioned also for the income statements, not necessarily equal cash. So we have mentioned, for example, differences in terms of depreciation that are not a cash expense. Another difference could be when you have multi-year contracts. And I think I mentioned this already in the income statement video. If you are receiving cash in 5 years for a project that you've done every year, although you're actually having revenues every year, you will only receive the cash in 5 years' time. And so in this case, doesn't necessarily mean that your business is not doing well. It's just that the reception of cash is down the line. So in the income statement, you will have every year revenues, but in the cash flow statement, you will only have the cash in 5 years. So keep in mind that although usually there's a relationship between income statement, revenues and profits, and cash flow statement cash, it in some cases will be different. And with this slide, we have finished today's class. I hope you have enjoyed. I will see you at the next recording. Bye-bye.